In the ever-evolving world of investing, one question remains constant. Where should I put my money for long-term growth? Today, we are diving deep into the top 5 ETFs that have not only stood the test of time over the past 5 decades, but also show promising potential as we look ahead to 2030. Whether you are a seasoned investor or just starting out, this video will provide insights into the ETFs that could be the cornerstone of your investment portfolio. So, why are ETFs such a popular choice among investors? Let's break it down. First, diversification. One of the biggest perks of ETFs is that they let you invest in a mix of assets, all in a single fund. So, instead of betting on just one stock or bond, you are spreading your risk across multiple investments. That way, if one underperforms, the others can help balance it out. It's a smart way to reduce risk without much effort. Next, they're cost effective. Compared to mutual funds, most ETFs have much lower expense ratios. That means fewer fees eating into your returns over time. And for long term investors, those savings can seriously add up. So you're basically getting good exposure to the market without paying a hefty price. And lastly, liquidity. ETFs are traded on stock exchanges just like regular shares. That gives you the flexibility to buy and sell them whenever the market is open. You are not stuck waiting for the end of the day like you would with some other investment options. It's fast, flexible, and super convenient. Starting with the Vanguard S&P 500 ETF. This is like your benchmark fund, your portfolio's backbone. It gives you exposure to the 500 largest US companies, so you're not betting on any one sector or stock. With an expense ratio of just 0.03%, is the lowest on this list, which makes a huge difference on the long run, especially when compounding returns. In terms of companies, you're getting exposure to the blue chip giants like Apple, Microsoft, Amazon, JP Morgan, Johnson & Johnson, and many more. So, you're holding the biggest names in tech, healthcare, finance, and consumer staples all in one ETF. It's like owning a little slice of the US economy. Sector-wise, technology leads the pack, but healthcare, financials, and industrials balance it out nicely. Risk is moderate, performance is steady, and that's the type of fund you could literally hold forever. Personally, I think everyone should have some woo. It's just efficient, diversified, and proven. Then comes VIG, the Vanguard Dividend Appreciation ETF. This one's interesting because it filters for the companies that have consistently increased their dividends over time. So you're getting stable, established businesses. Think Johnson & Johnson, Microsoft, Procter & Gamble. The expense ratio is 0.05%, which is still low but slightly higher than WU. The dividend yield is about 1.9%, and while that might not sound huge, it's solid when you're reinvesting and compounding. It underweighs high growth sectors like tech, so you're not chasing explosive returns, but that's kind of the point. You're trading off some upside for a smoother ride and income growth. I'd say this is perfect for someone who is in it for the long haul, values consistency, and doesn't want too much volatility. Now, QQQ. And here's where the tone shifts. This ETF tracks the Nasdaq 100, which is basically the US tech elite. But note, it excludes financials. So now you are heavily exposed to companies like Apple, Nvidia, and Amazon. The expense ratio jumps to 0.20%, which is the highest among all 5 ETFs here. And while that's still acceptable, it's something to keep in mind. QQQ has outperformed VOO and VIG over the last decade, but that comes with a risk. Because when tech drops, QQQ usually drops harder. Still, in a tech-driven world, I think it's worth having in your portfolio. But you have to pair it with something more defensive like VIG or even VXUS which we'll get to. If QQQ is tech heavy, VGT is full on tech overdose. The Vanguard Information Technology ETF doesn't just tilt towards tech, it is tech. It has over 400 holdings, but about 54% of the assets are in just 10 companies like Microsoft, Apple, and Broadcom. The expense ratio is 0.09%, making it the second highest on this list. Its beta is over 1.2, meaning it swings more than the market. So yeah, you're signing up for some wild rides. But with the AI boom, semiconductor demand, and cloud computing in play, VGT has serious growth potential. Just be aware, this one's not for the faint heart. It's aggressive. And finally, the VXUS, the Vanguard Total International Stock ETF. This one's all about going global. It gives you exposure to the thousands of companies outside the US. So you're looking at markets in Europe, Asia, Latin America, and some emerging markets like India and Brazil. The expense ratio is 0.08%, which is pretty decent. Not the cheapest here, but still way lower than what you would pay in a mutual fund. What makes VXUS interesting is that it spreads your bets across the globe. So you're not putting everything in one basket, especially not in the US market. And trust me, that's something a lot of investors overlook. You're getting exposure to the big international names like Nestle, Samsung, Toyota, Taiwan Semiconductor, and ASML. It's super diversified, like over 7,000 stocks, and that includes both developed countries and emerging economies, which can be volatile but offer major growth potential over time. If you found this video helpful, please like, subscribe, and share it with others looking to make informed investment decisions. Comment down if you have any questions or want to share your favorite stocks.